Tina Mitchell here with your money chat. The White House announced that the tentative railroad strike deal is in place, which is great news for supply chains and inflation. If this resolution was not to be reached, more than 100,000 railroad workers would have walked off the job, and the estimated cost to the economy would have been $2 billion per day. The August Consumer Price Index CPI reported showed that overall inflation increased by 0.1%. And although that is a low figure, it's larger than the negative 1% expected. Year over year, inflation declined from 8.5% to 8.3%, but was expected to drop to 8.1%. The real story here is the core rate, which strips out food and energy prices. It increased by 0.6%, which was double the expected of 0.3% increase. As a result, the year over year core inflation remained increased from 5.9% to 6.3%, which was hotter than the 6.1% expected. Shelter rose by 0.7%, which is the highest increase since 1991. Rents rose 0.7% last month, are now up 6.7% year over year, which is up from 6.3%. Owners equivalent rent, which tries to capture the rise in the home prices but does a poor job, also rose 0.7% and is up 6.3% year over year, up from 5.8%. Looking at more of the internal, energy prices fell 5% from a month ago, bringing the annual gain to 24%. Gasoline prices fell 11% and are up 26% year over year. Food prices, which makes up 14% of the CPI, climbed 0.8% in August, bringing the year-to-year gain to 11.4%. Explosion in credit cards, a sign of inflation impacting consumer, is credit card up 15% year over year, which is a record high. Credit card debt is growing at $33 billion per year, which is double the pace of a normal year. It clearly shows that people are relying on their credit cards to deal with the higher cost of inflation. As a result of the higher inflation, the Fed futures, which ties predicting what the Fed will do, is now pricing on 80% chance of a 75 basis point hike and a 20% chance of a 100 basis point hike in September 21st meeting. It's almost a lock that the Fed is going to hike 75 basis point. The Fed also just released their plan for mortgage-backed security purchases for the next 30 days, and it's at zero. Based on the Fed's holdings, they receive principal payments when people pay their mortgage, refinance, or sell their home. And the last 3 months, the Fed allowed $17.5 billion in mortgage-backed securities to fall off their balance sheet each month, but then bought mortgage-backed securities with the excess that they received above that. Now in September, the Fed is reducing their balance sheet of mortgage-backed securities by $30 billion, and based on the amount that they are receiving, they are not purchasing any additional, as they do not have more than $30 billion that they're currently receiving. Now, it's important to note, however, that they are not selling any of the mortgage-backed securities holdings. How will this impact mortgage bonds and mortgage interest rates? Well, it's going to be a bit of a balancing act, because while the Fed is no longer buying and allowing their balance sheet to run off, there is a lot less supply in mortgage-backed securities coming to the market because of the volumes being down. How long will the bonds slide? Well, mortgage bonds have broken beneath the falling channel that they have been since the beginning of August. After opening beneath the bottom line of the channel, bonds have regained some of their losses and are now testing at the level. If they go back or above the trend line, there is room for some in-turn gains. If they are rejected, they're likely retested that floor amount. So we'll have to see what's going to happen with mortgage bonds and how that's going to affect mortgage interest rates. Tina Mitchell here, and that is your Money Chat.